That's where Berkshire companies are selling their wares to shareholders. They have been doing that since yesterday. In fact, right now you're looking at a live picture. That's Warren Buffett arriving behind the scenes. You can see him walking through with Melissa. Melissa's in charge of this whole place, this whole operation.
So Warren Buffett just dumped $8 billion worth of stock. Let's see what this actually means for your portfolio. What happens when the world's greatest investor, who built a $300 billion fortune by buying and holding American businesses, suddenly becomes a net seller for 8 consecutive quarters? And why is Berkshire Hathaway now sitting on a record-breaking cash pile that exceeds the GDP of most countries? Today, we're breaking down why Buffett's billion-dollar move isn't just portfolio rebalancing, it's a flashing warning signal about where markets are headed next. Section 1. The unprecedented selling spree. Warren Buffett sold approximately $8 billion worth of stock in the most recent quarter. But here's what mainstream media completely missed. This isn't an isolated event. This marks the 8th consecutive quarter where Berkshire Hathaway has been a net seller of equities. Let me repeat that because it's crucial. 8 straight quarters of selling. The Oracle of Omaha, the man who famously said, "Be fearful when others are greedy, and greedy when others are fearful," has been systematically reducing equity exposure while the S&P 500 trades near all-time highs. Berkshire Hathaway's cash position now exceeds $325 billion. That's not a typo. $325 billion in cash and short-term treasury bills. To put that number in perspective, Berkshire is sitting on more cash than the market capitalization of Nike, McDonald's, or Coca-Cola. This represents roughly 30% of Berkshire's entire portfolio value. The last time Buffett held this much cash relative to portfolio size was right before the 2008 financial crisis and the dot-com bubble burst. However, here's where it gets interesting. Buffett didn't just sell random positions. He's been methodically trimming his largest holdings, including Apple, Bank of America, and other blue-chip stalwarts that he's owned for decades. When the guy who preaches our favorite holding period is forever starts selling his forever stocks, maybe that's worth paying attention to. Section 2. The Apple reduction. Let's talk about the sale that sent shockwaves through the investment community. Buffett has been systematically reducing Berkshire's Apple position, which at its peak represented nearly 50% of the equity portfolio. He's now sold more than half of that stake, liquidating well over $100 billion worth of Apple shares over the past year. For those who don't understand the significance, Apple wasn't just another stock in Berkshire's portfolio. Buffett called it one of the 4 pillars of Berkshire Hathaway, alongside the insurance operations, BNSF Railway, and Berkshire Hathaway Energy. He compared Apple's ecosystem and customer loyalty to Coca-Cola's brand moat. He said he'd love to own 100% of Apple if he could. So why is he selling? The mainstream narrative focuses on portfolio concentration risk and tax optimization. Sure, at a 50% portfolio weighting, Apple represented single stock risk that violated basic diversification principles. And yes, Buffett has mentioned taking gains at current tax rates before potential increases. But you don't sell half your position in your favorite business just for tax reasons. The real signal here is valuation. Apple currently trades at a price-to-earnings ratio around 30 times earnings. That's elevated by historical standards, especially considering the company's slowing growth rates. iPhone sales, which represent the majority of revenue, have plateaued. Services growth, while strong, can't offset hardware stagnation forever. Buffett built his fortune buying wonderful businesses at fair prices, not paying premium prices for wonderful businesses. Section 3. The Bank of America exit. Now let's examine another massive position reduction that few people are discussing properly. Buffett has been systematically selling Bank of America, another long-term holding that Berkshire accumulated during the financial crisis. He's sold billions worth of shares, reducing Berkshire's stake significantly. Bank of America represents everything Buffett typically loves: a well-managed financial institution with strong deposit franchise, improving return on equity, and reasonable valuation. The company emerged from the financial crisis stronger, cleaned up its balance sheet, and built one of the largest deposit bases in American banking. So why sell now? The answer likely relates to what Buffett sees coming in the banking sector. Commercial real estate exposure remains a significant concern, with office vacancy rates at record highs and property values declining. Regional bank stress, while contained so far, reveals underlying fragility in the financial system. Interest rate risk on bank balance sheets persists as a threat. More importantly, Buffett has lived through enough banking crises to recognize warning signs before they become obvious to everyone else. He's seen this movie before in the savings and loan crisis, the financial crisis, and numerous regional banking failures. When the greatest financial mind of our generation starts exiting bank stocks, maybe that's information worth incorporating into your worldview. Section 4. What the cash pile reveals. Berkshire Hathaway's $325 billion cash position isn't just a number, it's a statement. It represents Buffett's assessment of available opportunities relative to valuations. And right now, that assessment says, there aren't enough attractively priced investments to deploy this capital. Think about what that means. Berkshire has an army of analysts, unlimited capital, access to any deal in the world, relationships with every CEO worth knowing, and the most successful investor in history making the final decisions. And they can't find enough good investments at reasonable prices. That should terrify anyone who's overweight equities at these levels. The composition of that cash matters too. It's not sitting in checking accounts earning nothing. It's deployed in short-term treasury bills, currently yielding around 5%. That means Berkshire is generating roughly $16 billion per year in risk-free interest income. While waiting for opportunities, Buffett is essentially getting paid 5% to be patient. Compare that to the S&P 500's earnings yield, which is the inverse of the P/E ratio. At current valuations around 22 times earnings, the market offers an earnings yield of roughly 4.5%. So Buffett can earn more in treasury bills with zero risk than the earnings yield of the overall stock market. No wonder he's not buying. Section 5. The valuation warning. Here's what financial media won't tell you directly. By any historical measure, US stocks are expensive. The Shiller-Cape ratio, which smooths earnings over 10 years, sits around 35. That's well above the historical average of 17 and approaching levels seen only before major market crashes in 1929, 2000, and 2008. The Buffett indicator, which compares total market capitalization to GDP, recently hit 200%. Buffett himself has called this the best single measure of where valuations stand at any given moment. The historical average sits around 70%. At current levels, this indicator has only been higher during the peak of the dot-com bubble. Market concentration represents another concern. The Magnificent Seven stocks, Apple, Microsoft, Amazon, Google, Meta, Nvidia, and Tesla, now represent roughly 30% of S&P 500 market capitalization. That's concentration rivaling the dot-com era when Cisco, Microsoft, Intel, and Oracle dominated indices. When that concentration unwinds, and it always eventually unwinds, the damage spreads throughout portfolios. Corporate profit margins sit near record highs, which historically mean reverts. When margins compress, and they will eventually, earnings will disappoint relative to current expectations. Stock prices, which ultimately follow earnings, will adjust accordingly. Buffett understands mean reversion better than anyone, and he's positioning accordingly. Section 6. The opportunity cost. Let me explain something that most retail investors completely misunderstand about Buffett's strategy. He's not market timing in the traditional sense. He's not trying to call the exact top or predict a crash next week. What he's doing is recognizing that at current valuations, the opportunity cost of being fully invested is simply too high. Opportunity cost means what you give up by choosing one option over another. If you deploy capital buying stocks at elevated valuations, you sacrifice the ability to deploy that capital during a significant correction or bear market when genuinely attractive opportunities emerge. Buffett experienced this firsthand during the financial crisis. In 2008 to 2009, when the world was ending and everyone was panicking, Buffett had capital ready. He made legendary investments in Goldman Sachs, Bank of America, and other businesses at distressed prices with terms that would never be available in normal markets. Those investments generated returns that would be impossible to achieve buying at today's valuations. The key insight is this: Buffett would rather earn 5% risk-free in treasury bills and wait for better opportunities than commit capital to overvalued stocks offering lower expected returns with substantially higher risk. That's not market timing. That's intelligent. Capital allocation based on risk-adjusted return expectations. Section 7. What retail investors miss. Here's what separates successful investors from everyone else. They understand that staying fully invested at all times isn't some natural law of the universe. The financial industry conditions people to believe they must always be 100% invested in stocks, conveniently ignoring that this belief primarily benefits fund managers collecting fees on assets under management. Buffett doesn't operate under that constraint. When valuations are attractive, he's aggressive. When they're stretched, he's cautious. When they're compelling, he goes all in. Right now, for 8 consecutive quarters, he's been cautious. That should tell you something about his assessment of risk-reward at current levels. The mainstream narrative claims Buffett can't find investments because Berkshire has grown too large, limiting the pool of acquisition targets large enough to move the needle. That's partially true, but intellectually lazy. Berkshire could easily deploy $50 billion buying stakes in large-cap stocks if Buffett found valuations compelling. He's not doing that. He's selling. Another narrative suggests Buffett is preparing for his succession, positioning the portfolio conservatively so his successors inherit maximum flexibility. Again, partially true, but incomplete. Buffett has been very clear throughout his career. He allocates capital based on opportunity sets, not based on what might be convenient for future management. Section 8. The signal for your portfolio. So what does this mean for your investment strategy? Should you panic and sell everything? Of course not. Buffett himself would tell you that market timing rarely works for individual investors. But you should probably adjust your expectations and risk exposure based on current market conditions. If you're overweight equities relative to your normal allocation, especially in expensive growth stocks or concentrated positions, maybe this is a good time to take some profits. You don't need to go to cash completely, but reducing equity exposure from, say, 90% to 70% could provide dry powder for future opportunities while reducing downside risk. If you're holding stocks with unrealized gains that you've been meaning to trim but kept riding because stocks only go up, perhaps Buffett's actions provide the nudge you needed. Taking profits is never wrong. You can always buy back in lower if genuine opportunities emerge. The mistake is holding through a major correction because you are too greedy to lock in gains. If you're approaching retirement or already in retirement, this is especially relevant. Sequence of returns risk means that a significant drawdown early in retirement can permanently impair your financial security. Having 2 years of expenses in cash or short-term bonds provides buffer against being forced to sell stocks at depressed prices to fund living expenses. For younger investors with decades until retirement, market pullbacks represent opportunities rather than threats. But even then, having some dry powder to deploy during genuine panic creates asymmetric return opportunities. Buffett's current positioning suggests that those opportunities may be coming sooner than most people expect. Warren Buffett just sold $8 billion worth of stock, marking the 8th consecutive quarter of net selling, while Berkshire's cash pile swells to a record $325 billion, earning 5% risk-free. The question is, will retail investors recognize this as a warning signal about current market valuations and adjust their risk exposure accordingly? Or will they ignore the Oracle of Omaha's actions and learn the hard way why valuations eventually matter? Drop your thoughts in the comments, and if you want analysis on what the smart money is doing before mainstream media figures it out, hit subscribe. See you in the next one.